Vietnam's foreign reserves have been dropping lately. Here's a graph showing Vietnam's foreign reserves per year. As you can see, Vietnam's foreign reserves has steadily risen, where in 1995, the country's reserves stood at just $1.32 billion. But by 2021, their total reserves has risen to a massive $109 billion, representing a staggering 82-fold increase over the span of 26 years. However, if you zoom in onto the latest data, we get to see a far different picture in the latest years. In the month of January for 2022, Vietnam's foreign reserves stood at $110 billion, yet as the data shows, its reserves dropped month after month, with the latest data showing that Vietnam's reserves is now just at $82.3 billion, which is a 25% decline within a span of less than 2 years. This is a rather surprising aspect about Vietnam's economy. After all, Vietnam has been at times crowned as the next economic tiger of Asia. They have grown from nothing to one that has outperformed many other Asian economies. Yet, foreign reserves, which serves as a key indicator of a country's economic stability, has been dropping. So why? Why is Vietnam's foreign reserves dropping? Is it signaling a rather weaker economy than what we have always heard about Vietnam? Well, to understand this, it is first important to understand how a country incurs foreign reserves, and only then can we tell how Vietnam's foreign reserves have dropped. There are various ways a country increases their foreign reserves. These ranges from trade, foreign direct investment, FDI, remittances, tourism revenues, and effective fiscal and monetary policies. But amongst the biggest factors out there belongs to no other than balance of payment, BOP. The balance of payment is basically data that records all the economic transactions between a country and the rest of the world within a specific period. The reason why this affects a country's foreign reserves is simple, and it is because the balance of payments, BOP, determines whether more foreign currency is entering or leaving the country. When a country has a BOP surplus, meaning it earns more foreign exchange through exports, FDI, and other channels than it spends on imports and debt repayments, it accumulates foreign reserves. Conversely, a BOP deficit results in a net outflow of foreign exchange, which depletes reserves. The balance of payment has two main components, the current account and the capital and financial account. Both play crucial roles in determining the movement of foreign reserves. Let's first start with the current account. The current account records a nation's trade balance, exports minus imports, net income from abroad, and net current transfers, such as remittances. To put this simply, a current account balance can be in a surplus or deficit. If it's in a surplus, that's because Vietnam could be exporting more than they are importing. They could be receiving net income from abroad and receiving more remittances. This is easy to identify, right? Vietnam is a massive exporter globally. Here's a graph on Vietnam's exports of goods and services as published by the World Bank. As you can see, their exports of goods and services have continuously grown, with the latest year available for 2022 showing exports of over $384 billion. Furthermore, it is also true that Vietnam is a big receiver of remittances. Here's a table of a select personal remittances received as published by the World Bank. As you can see, while Vietnam is not the world's largest receiver of personal remittances, they still received over $14 billion in 2023. That's more than Italy, Thailand, and even the United States. But of course, the reason why personal remittance is high in Vietnam is because of its significant overseas workforce and diaspora. Vietnam has a long history of labor migration, with millions of Vietnamese working abroad, countries ranging from the Western nations to neighboring Asian economies. Personal remittances, or remittances in general, are then added to what we call as net secondary income. Net secondary income adds up remittances, government transfers like aid and development assistance, and other transfers between international organizations and countries. Here's a graph with data published by the World Bank on that matter. As you can see, Vietnam's net secondary income has been in surplus. Other than net secondary income, the second component of the current account is primary income. Primary income, on the other hand, has been on a deficit, as you can tell from the graph right here. Why is that? Well, that's mainly because of one actor: foreign investors. There's a lot of foreign investments in Vietnam. It has emerged as one of the best places to invest as of recent years. As a matter of fact, its biggest foreign investor, known as Samsung, has invested more than $20 billion as of early 2023. Here's a separate graph on Vietnam's foreign direct investments, FDI data. As you can clearly see, Vietnam's FDI is really substantial, and a lot of these can be attributed both to Samsung and South Korean investors. Now, there's a lot of benefits that foreign investors bring to one's economy. They contribute to Vietnam's exports, for instance. Vietnam is home to Samsung factories. These factories then manufacture Samsung phones, which are then sold to other countries, like Vietnam's neighbors, ranging from the Philippines to Malaysia, Indonesia, Thailand, and so on. These exports then help Vietnam, as it brings employment and foreign currency, which adds up to Vietnam's current account. However, what this data misses out on is that while foreign investors bring money and employment to Vietnam, they also take out money from that country. That is where net primary income comes in. The reason why, in the latest year available for 2023, Vietnam's net primary income is a big deficit of $22.4 billion is because foreign investors repatriate their profits, dividends, and interest back to their home countries. When multinational corporations like Samsung earn profits from their operations in Vietnam, a substantial portion of these earnings is sent back to South Korea. Similarly, other foreign companies and investors operating in Vietnam also remit their earnings abroad, contributing to the negative balance in Vietnam's net primary income. Now, we got to add all of these up: net primary income, net secondary income, and the trade balance to get the overall picture of Vietnam's current account balance. Here's the graph with data we collected from the World Bank on Vietnam's current account balance. As you can see from the graph right here, Vietnam's current account balance has been mostly positive since 2011. With the latest data for the year 2023 showing a current account balance surplus of over $25.09 billion. The current account, being surplus, just means that Vietnam is earning more from its interactions with the global economy than it is spending. A huge part of it is indeed because of exports and net secondary income, which help offset the net primary income. Other than the current account, the other contributors to the balance of payment are the capital and financial account. These accounts track the flow of financial capital and investments between Vietnam and the rest of the world. The capital account includes things like one-time transfers of ownership, such as debt forgiveness, inheritance, or migrant transfers. These, however, do not really contribute significantly to Vietnam's overall BOP. What does, however, is the flow of financial capital. Here's a graph on that matter with data from the World Bank. As you can see, the net financial account of Vietnam hasn't really been on a consistent surplus. As a matter of fact, in the years of 2021 and 2022, Vietnam recorded big deficits, with the year 2022 showing a deficit of over $32.22 billion. The reason for this, however, is due to several reasons. It includes things like an outflow in portfolio investments, which back in 2021 and 2022 was largely driven by global financial tightening and rising interest rates in developed economies. During this period, central banks in the United States and Europe aggressively raised interest rates to combat inflation, making their markets more attractive to investors. As a result, foreign investors pulled out capital from emerging markets like Vietnam, leading to significant outflows in portfolio investments. Then, there's also debt repayments, which in recent years we saw the rise of Vietnam's external debt. Other reasons here also include currency stabilization, which, as many news reports said, the State Bank of Vietnam, also known as its central bank, has made stabilization efforts. This is to maintain the stability of the Vietnamese dong amid global financial fluctuations. They also include data on Vietnamese investments abroad, which might not really be very significant, but it still adds up. Other data is also included, which we may not discuss fully. Hence, as you can already tell from the entire story, part of the reason why Vietnam's foreign reserves has dropped from 2021 to the latest data is because of the net financial account. Even though Vietnam continues to record more exports than it imports, and a good current account balance, other contributing factors haven't really been good. Finally, the last piece of the puzzle that we want to discuss here is the graph right here called Net Errors and Omissions, BOP, current US dollars. What this graph is about is basically the unexplained or unaccounted for discrepancies in Vietnam's balance of payments. To put it simply, it is the missing piece that ensures Vietnam's balance of payments, BOP, balances mathematically. It represents transactions that were either misreported, not recorded, or delayed in one of the BOP components, the current account, capital account, or financial account. As you can see, Vietnam's net errors and omissions have mostly been negative. In 2022 and 2023, their net errors were over $33.6 billion and $16.6 billion, respectively. This can have a negative effect on Vietnam's total reserves, because a negative net error and omissions indicates unrecorded outflows of capital. These untracked outflows reduce the foreign exchange available to Vietnam, ultimately impacting its total reserves. So as you can see, Vietnam's total reserves have dropped significantly due to several factors. But what we have yet to discuss is the danger of depleting foreign reserves. The dangers of lower foreign reserves vary from country to country, depending on their economic structure. But one of the biggest problems that we can see is the fact that Vietnam has too much imports and external debt as compared to their total reserves. Here's a graph with data from the World Bank on Vietnam's total reserves and a percentage of total external debt, as compared to regional countries. As you can see, for the latest data available in 2022, Vietnam is only higher than Indonesia on this matter, but lower than Thailand and the Philippines. Why this indicator is so important is because it provides a snapshot of how well Vietnam is positioned to handle external debt obligations and withstand external economic shocks. A higher percentage of reserves relative to external debt reflects a cushion that can protect the economy during times of crisis, such as a sudden capital outflow, currency depreciation, or external trade imbalance. Vietnam's relatively lower standing compared to regional peers highlights potential vulnerabilities in its external sector. Then, there's also this data set right here, which is the total reserves in months of imports. In the latest data available, it only shows 3, which is very low. You can see that Indonesia has 6, the Philippines at 8, and Thailand at 8 as well. Having only 3 means that Vietnam's total reserves can cover only 3 months' worth of imports, which is considered the minimum threshold recommended by international financial institutions, such as the IMF, for maintaining economic stability. Falling below this level would indicate heightened vulnerability to external shocks, such as sudden increases in global commodity prices, disruptions in trade, or currency depreciation. But we can't immediately conclude that Vietnam's economy is in danger, as many other factors are in play. But anyway, do let us know what you think. Thanks for watching.